All right, Dhiraj Sachdev also joining us this afternoon. Let's get his view on that. Dhiraj, on the metal story that's clearly playing out today.
Yeah, hi, good afternoon, Aisha. I think clearly we are seeing metals where valuations have turned attractive, and commodity prices globally are seeing an improving trend, whether it is ferrous metals, non-ferrous metals, including precious metals. We saw how silver and gold have also done well, exceedingly well over the last few months or so. So there is obviously an expectation that the global recovery will happen in autos, construction, as Nikunj was also pointing it out, that Chinese demand has been on a very strong wicket. So these have led to prices on an uptrend quite strongly over the last few months.
Right, Dhiraj, I was speaking to the management of Cipla yesterday. The stock is at an all-time high, and these were the words from management of Cipla. Things are looking up, but in this COVID world, there has been an incremental jump in our business. There has been no exponential change in our business trajectory. But the stock prices of pharma companies are perhaps expressing that there is going to be an exponential jump in the COVID world for pharma companies. So do you think somewhere pharma stocks are not running ahead of themselves, but they are way running ahead of themselves?
So Nikunj, if you actually see pharma companies in the first quarter results so far that has been declared, have done exceptionally well, particularly those operating in the API space, select chronic therapies and also complex generics. This may be largely led by or partially led by supply shift from China. And also the pricing improvement and lower raw material costs. So pricing improvement and lower raw material costs, one can be still skeptical about whether this is going to pan out and play out over the next few quarters as well. But the fact is that the supply to regulated and unregulated markets are expected to continue the momentum, given the global market size is fairly huge. But as you rightly pointed out, that clearly one has to be selective, as in few cases, if not all, pricing and margin improvement may not actually sustain. But broad structural long-term growth story remains intact. So not only the API companies will sustain their growth momentum, barring few where the margins can sustain, the domestic prescription-driven drugs business are also expected to do well due to their strong growth brands and domestic launches. So overall, we actually believe that pharma as a pack should sustain, despite the fact that there could be near-term consolidation. Second quarter, some of them may see margins not sustaining as well as in the first quarter. But overall, the pharma sector looks good.
Dhiraj, would it be prudent right now to make some hay while the sun shines, which is take some chips off the table? The market run-up has been strong, and when Q2 numbers will start coming out, when the festival season will start coming out, we could be in for some disappointment. Do you think it makes sense to, let's say, raise a substantially higher amount of cash than normal, 10 to 15% for some, 20 to 25% for some, but do you think it is imperative to sit on some cash now?
So Nikunj, currently number of people waiting for market to correct to deploy money is touching an all-time high. While the stocks are also touching an all-time, equally the behavioral science is suggesting that the number of people are waiting for the correction to deploy money. And when that happens, typically correction becomes even more elusive in the near term. I'm not saying that correction will not happen, but the kind of surprise where people are, ascribing to this rally as if correction is bound to happen, and this is unreasonable. Now, let us take, an example. We clearly believe that trying to time the market or attempting to time the market is a futile exercise. We all know how the markets react so sharply and swiftly when in the month of March and what we are today. I think it has been a clear extreme situation how the market has behaved. So nobody can time the market. Nobody can time the market correction. What we as fund managers or investment firm do is clearly buy good businesses which are cash flow generating, scalable business opportunity, of course with an eye on the valuations. At times it may run ahead of time given the near-term earnings, but if you believe that 2 or 3 or 5 year story structure looks intact, then we may rather retain it unless we buy or we have another opportunity. So given that equity market always precedes economic bottom, there will always be a disconnect between market rallies and ground level reality. In general, market is focusing beyond short-term demand issues and seems to have factored in worst ever quarterly numbers. So I think timing is a futile exercise as more factories open up, as more data points such as e-way bills, power consumption, online payment, Google mobility trends are indicating month-on-month improvement. I think markets are recognizing that near normalcy levels that we are trying to achieve amidst the midst of COVID.
Yeah. Dhiraj, so then by that logic, would you say right now is the time to maybe double up your banking positions, assuming that the recovery will happen, be it 2 years, 3 years, or whenever it may? Or would you wait out and see how the NPA positioning, once the moratorium gets lifted, actually plays out to take perhaps more concentrated calls?
I think very relevant question, Aisha, because financials are at a different trajectory and the market, whether it's small caps, metals, pharma, are on a different trajectory at this point of time. So financials, by that logic, offers relatively highest margin of safety post sharp correction, provided there is access to capital and quality of book is secured. Now, as normalcy in business comes back, we expect collection efficiency to improve gradually. At this stage, would rather prefer secured lending companies, whether it's some of the top private banks or housing finance, those who have low exposure to builder loan because builders are into stress. Microfinance companies being unsecured are at risk, but given that their target market is rural lending or agriculture that are in the essential category, we believe selective opportunities also exist in microfinance despite the fact that they are unsecured lending. So overall, the financial services definitely may go through a very volatile phase in the short term. Challenges exist in the near term related to moratorium, asset quality and growth. We've already seen a spate of fundraising exercise which has been resorted to by many NBFCs in the recent past to shore up their capital in this tough environment. I think the better handle will be on the credit cost once the moratorium period is over and whether borrowers will make payments or not for a few months post the moratorium period. I think that remains to be seen going forward. So one cannot completely double up the position. One has to be very gradual, selective in the entire NBFC or banking pack, and one has to be extremely selective. Cautiousness is the need of the hour even at this point of time for overall NBFC and banks.
Dhiraj, let me get your take on the PSUs. I mean, yesterday we saw a big knock on Concor with potential sort of uncertainty with regards to the land lease issue. I mean, this is positive in the sense that at least the government seems to be hell-bent on trying to get privatization going, having of non-core here on SCI. But perhaps the delays, the uncertainty still causing some nervousness or a lack of interest really in not necessarily across the board, but in a fair few of them.
I mean, that's always going to be the case because privatization is never easy, Aisha. I think we have seen time and again there have been delays and a lot of PSUs are owning some of the strategic marquee assets which needs to be offloaded for them to have cash flows so that they can focus on the core business. But we can't generalize again PSU in one category because some of them are really good, especially some of them which are in the defense segment, etc. We already saw how the import substitution clause will benefit them over a multiple period of about 5 to 7 years. There are almost 4 lakh crores of orders can largely accrue to them besides some of the private players which are in the defense business. But suffice to say, privatization will always create issues because you need a strategic partner globally who can infuse money and government obviously needs to reduce the stake as quickly as possible so that the fiscal stress gets eliminated and that money can be channelized for more productive purposes.
Okay, so that's on the PSUs and the privatization drive as well. While we're on, some of the PSU names, what about the banks? I mean, they've completely lagged behind so far, of course. What's your view currently when it comes to some of the PSU banking names?
It has been an issue. Banks had always perennial issue on the asset quality side, and you would already see institution participation quite low, except for a couple of names like Bank of Baroda, etc., where some of them are showing some improving trends. By and large, I think they have stress on the ability to take on market share versus private banks. They are also lagging behind on the technology side versus private banks. And third is the recapitalization continues to happen. ROEs are low versus, again, private bank peers, etc. So you see perennial dilution of equity below book, which obviously hurts re-rating potential for most of the PSU banks. So there will be odd ones. The large couple of ones may still continue to do well because they're very solid franchisee of CASA deposits, and that is a low-cost competitive advantage for them. But otherwise, structurally, the asset quality has been a perennial issue, especially in times of crisis.
Okay.
Dhiraj, how do you propose one could benefit really with what is happening in gold and silver prices? One way is to directly invest in them. Second way is to bet on a company like Titan. Third is that you buy a Manappuram or a Federal Bank, companies which essentially will get renewed business because of gold financing.
I'm not an expert in bullion or gold. The focus is largely on equities and equity investing. But yes, the quasi plays, as you mentioned, whether it's a gold finance company, some of the mining companies which are into silver. We know how Hindustan Zinc is the sixth largest silver mining company in the world. And obviously the jewelry company, given the fact that the festive season is around the corner, apart from investing. I mean, that's the play to play through equities. Globally, gold obviously rally has been because of lower interest rates and the risk of, in some cases, where how the COVID environment will pan out is leading to this rally. But honestly speaking, I am not really an expert to talk about how 6 months later, 1 year later, gold will look like, or the outlook of the businesses.
Dhiraj, one very basic puzzling question which is troubling every investor is that 8 out of 10 funds have managed to underperform the benchmark on a 10-year basis. Why is that happening?
Can't say anything, difficult to answer, but the fact is that if there are large cap funds, you know what has happened to Reliance. And traditionally in the last 10 years, there has been considerable underweightage on Reliance as the stock in the portfolio, which meant that if Reliance does extremely well in the last few years, the underperformance is difficult to catch up on an overall basis. I think this is one of the stark reasons where the less ownership versus the index, as far as Reliance is concerned, is one of them. Second, what I can visualize is that most of the fund managers were also hugging, and there was hugging the benchmark, and also were higher on the financial sector weightage. Like the financial sector has got derated, given the fact that the outlook on the SME recovery or collections can get impacted. Then you're actually facing problems on the overweight stance in the financials, because financials have done extremely well from 2013-14 period all the way till 2018-19 period. So these are the two mega reasons to my mind which has led to underperformance of most of the funds vis-a-vis benchmarks.